With all the doom and gloom about the UK economy recently, you might have understandably missed that UK debt has actually fallen. The most recent data shows that the UK government debt is down by £1.5 trillion. So in this video, we're going to explain how this has happened and what it might mean for the UK economy. If you're new to the channel, welcome to Modern Money Talk, where we talk all things personal finance and economics, where I draw on over a decade of finance experience. So every year, the government basically does an audit of absolutely everything. And the accounts for the end of 2022 show that the UK's total national debt is almost £3.9 trillion. And for the most part, this is the number that's most often cited whenever there's a discussion about UK national debt. But the interesting part is that when you compare this to the most recent figures, which take us up to the end of 2023, that shows that national debt has reduced to £2.4 trillion. But before we go any further, we really need to explain what the UK national debt is. Apart from the borrowings, which you can see here, with the Bank of England holding a pretty big chunk of UK debt through its asset purchase facility, it's basically the sum of all money owed externally. But an important component of that is that this includes commitments for money that the government is going to have to pay out in future, which is what in accounting terms we call a liability. And it's basically the culmination of all these liabilities that allow us to calculate the national debt. More on this a bit later. So going back to these two numbers, that is a reduction in the national debt of £1.5 trillion. Now, we get into the millions and the billions and the trillions, and it can start to feel a little abstract. So let me put it another way. That's the equivalent to 50 million nurses, about 3,500 hospitals, 500 new aircraft carriers, and almost 200 million kilos of butter. Hope that helps. And the truth is that this is an enormous amount of money that the government no longer owes, according to its own audit. But how did this happen and why? And what will the government do with this news? So on the screen here, we effectively have a profit and loss for the UK. That's all the money that was spent and all the money that was received in a single year. And then we get to this line here. Now, generally, what you can see is that for the most part, people and businesses facing finance costs should be exactly that. They should be a cost. In your own personal circumstances, it'll be interest on your car loan or on your mortgage. And indeed, in the previous year, you can see here that for the UK government, it was a cost. But then for this year, we see that it's a negative cost, which is what basically it being in bracket means, which to all intents and purposes means that this is finance income. There was a cost last year of 197.2 billion, which is when interest rates are much lower. But then there was a finance income in tax year 2022 to 23 when interest rates had actually risen. Now, we should clarify that whilst the cost of the UK government financing its debt has gone up, which we would expect as the Bank of England has increased rates over the course of the last 2 years, you can see that increase here from 44 billion to 78 billion. The plot does thicken, so let's look at this in a bit more detail. So we move on to what is effectively the UK balance sheet. This shows all the UK's assets and liabilities in a single place. And we can think of this as net debt for the government. That's the total assets or the total things it owns, less the total liabilities, which we've already discussed. So how does the UK debt fall so much? Well, the how and why is actually pretty simple. Pensions. Let me explain. So the UK has civil servants who are employed as teachers, NHS workers, they're in the armed forces and so on, and they benefit from UK government pensions. These two numbers here represent the financial commitment that the government will have to pay out to these people when they hit retirement age. Now, when we look at the numbers, you'll see that in 2022, the total amount for these pension liabilities was, as we mentioned, 2.4 trillion. But we should point out that pension liabilities are the largest liability that the UK government has, which was 42% of the UK's total liabilities. And let's take a look at this 2.6 trillion broken down by each pension scheme, because I think it's really quite illustrative about what we're talking about. NHS pensions are just here with just over £1 trillion. Then we have teachers at a little over 608 billion and so on and so on. But when we dive into these figures for 2023, this figure has fallen from 2.6 trillion that we've just been discussing to 1.4 trillion. And that, folks, is the main driver of the fall in UK net debt. But that's not all, and we really need to dive into this a bit more to understand it. We should be very clear that the UK liabilities, or as we've discussed, future payments that the government is going to be on the hook for when it comes to these public sector workers' pensions, if the value of that falls, then overall national debt has fallen. So that's how the UK debt has fallen as much as it has. The UK audit has basically determined that the value of the pension liabilities for UK public sector workers has decreased by this astronomical 1.5 trillion amount. But that still leaves us with the why. Why has this number gone down so much? Well, ultimately there are two reasons, and actually it's kind of straightforward. Here we have a graph of UK interest rates over time. We have the historically low rates in the aftermath of the global financial crisis, which pretty much stayed there. Then we get this small cut in 2020 with the onset of the pandemic. And then we get to the start of 2022, as the Bank of England started to ratchet up rates in order to combat inflation fueled by supply chain disruptions and energy prices going absolutely through the roof. The idea here is very simple. If you make it more expensive to borrow and offer better value for savers, this will take some heat out of the economy and will cool inflation. I have my own views about why this doesn't work in this particular instance, but that's another video for another time. Now, you might be thinking, whilst interest rates went up to try and quell inflation, what does that mean for us here? But for the purposes of the numbers we're looking at here, it had quite a different effect. As interest rates went up, the expectation is that higher interest rates are presumed to indicate a higher rate of return that will be made on investments. The implication is that the increase in interest rates paid by the government means that the cost of servicing future obligations will fall because more investment return will be made. So to recap, because the interest rate went up, the government owes a lot less in future. That basically means that the government has to come up with less of that money. So as interest rates go up, the expectation of returns improves, and therefore the amount that the government has to cough up, effectively the difference, falls. So whilst increasing interest rates has meant that household finances have been put under more strain through increased mortgage and rent repayments, companies having to pay more in interest to service their own debt, for the public finances, there's an upside because, as the accounts show, UK national debt has fallen from 3.9 trillion to 2.4 trillion. But we said that there were two factors, so let's get on to the second one. You see, when it comes to a liability like this, the government doesn't get one massive bill one year. And as we've discussed, this is a liability that's going to be drawn down over time, over decades, in fact. And so to recognise that, the government does, as pretty much every business does, they discount it over time. This discount rate is attached to the Bank of England base rate. As the Bank of England increase rates, the discount factor, which is used in these calculations, means that the pension liabilities look more favourable for the government. And this wasn't entirely unforeseen. Take a look at this article here from March 2024. Public sector pension liabilities could reduce by 1.2 trillion, saying, quote, public sector pensions are the largest liability within the government, with more than 2.6 trillion, dwarfing borrowing costs and other financial liabilities. But the Treasury anticipates reductions of around 1 trillion for 2022-2023 and an additional 200 billion in 23-24 accounts respectively. So this wasn't entirely unexpected and something that could have been predicted in 2024, if not before, and that much of what we've discussed is also in this article here. Just look at this segment here. The largest NHS pension scheme currently receives more income than it pays out, with the surplus cash going to the Treasury. For the other three large unfunded schemes, the picture looks different. Payments exceed income, so Parliament uses tax income to subsidise the schemes. And again, just to throw even more information at this, we have this analysis here from the ICAEW, which shows kind of the change quite nicely in this diagram here. And there's this commentary that basically outlines it. Service costs added 117 billion to pension liabilities during 2022-2023, and the net interest added a further 48 billion. These increases were more than offset by the 1.269 billion in net actuarial gains. This is linked to the change in the discount rate that we mentioned earlier. 50 billion in payments to pensioners in the unfunded schemes and 70 billion in other movements. But an important point to remember is that this is a liability that will be reduced over decades. There'll be civil servants who are working now who won't be owed a pension for years to come. So whilst it seems the UK has less debt, which is a good thing, there is a flip side to this, which is that the outstanding debt that the government has to service will go up. And that's going to be the next topic that we discuss. So whilst UK pension obligations and therefore UK debt might have fallen pretty drastically over the last couple of years as a result of rising interest rates, one thing that has not fallen drastically as a result of these rate increases is the cost to the Treasury to service UK debt. And there's been plenty of coverage all over the place. You can see here that the cost to the UK government in pounds, shillings and pence of what it costs to service the debt. This is basically fueled by two things. And really, as the UK has become more indebted, the sharp rise in interest rates have made this debt more and more expensive to service. Morningstar writes, the 30-year gilt yield is now at levels last seen since the 1990s, and the 10-year gilt is trading at its highest level since 2008. Few reasons that gilt yields have gone up. One is the prospect of the UK's weakening economic position. A whole string of bad economic data has meant that investors might not view the UK as being as sound an investment as they would like, and so they factor the risk into the rate they're going to charge in order to lend money to the UK. Secondly, we have the possibility of higher inflation for the longer term, which means higher interest rates for longer. One of the other potential factors is that markets are moving a little more cautiously with news coming out of the US. There's a great deal of uncertainty around what Donald Trump is going to do now he's back in the White House. The potential threats of tariffs means that prices are likely to go up as importers pass these tariff costs on to consumers. Investors basically worry that this will lead to more persistent inflation than previously thought, and therefore, again, interest rates will have to stay higher for longer. And we should also note that yields are not just rising in the UK. Borrowing costs have also gone up in the US, Japan, Germany, and France, for example. But what does all this mean? I would say it's like having a smaller mortgage, but getting charged a higher interest rate. One is going to benefit you in the longer term, but the other is going to be a bit more painful in the shorter term. And I think this is really kind of a nice explanation for it. Say your lender says we're going to take 10% of your total outstanding balance off your mortgage, but we're going to charge you an extra percentage point for it. But what's this going to mean for the government? Now, clearly this is going to have an impact on day-to-day spending for the government for one very simple reason, and that is the cost to the government to service this debt is going to increase. Because for the most part, interest payments on the government's past borrowing are a relatively big cost for the government. In 2023-24, government's net debt spending was £102 billion, which is equivalent to 3.8% of GDP or 8.4% of government spending. And in the last 2 years, the government has ended up spending more on debt interest payments than it did before. This is largely because interest paid on around a quarter of the government's debt is also linked to inflation, which accelerated over the last couple of years, as well as rising interest rates. So you get the real kind of double whammy there. So what does all this mean for the UK economy? Well, I think the short answer is it's a combination of good news and bad news. The good news is that UK national debt has unequivocally fallen by about £1.5 trillion. Absolutely a good thing. As we've talked about extensively and in a great deal of detail in this video, that is driven by a couple of primary things. One of the primary drivers is that as UK interest rates have gone up, this has changed the discount factor which is used to value these future liabilities, predominantly coming from public sector pensions. This makes up the bulk of the change. But as we talked about right at the start of the video, there was also this negative finance expense, which basically means that the government is earning money from some of its investments. These again have gone up as interest rates have gone up. So that's the debt side. That's the good news. The bad news, however, is that as Bank of England interest rates have gone up, the outstanding debt has become more expensive to service. We've talked about how this increase over time has meant it takes up a greater proportion of the UK budget every single year. And we've also talked about how it's taken up a lot of the so-called fiscal headroom that Labour had really been banking on. And I would still stick with this analogy, that for the shorter term, the government is going to be paying slightly more in interest costs. That seems to be completely inescapable. And with the most recent Bank of England forecast showing inflation staying higher for longer, that's likely to be the case for the foreseeable future. But at the same time, this reduction in overall debt and overall pension liabilities might help to alleviate some of the longer-term fiscal challenges that the UK faces. Thanks very much for watching. If you've liked this video, please like and subscribe. This is Modern Money Talk, where we talk all things personal finance and economics. Thanks very much for watching.